Thanks for having me on. It's when I had started my meetup in 2010, it was actually a goal for me to become a Phoebe meetup group, and at that point they weren't expanding to the San Francisco Bay Area, and then things changed. We kind of walked away from the whole meetup concept, but it's lovely to actually be presenting at a Phoebe meetup. Thanks for having me, Christina
Yeah.
and team.
Yes.
Um, this presentation is the most challenging one I've ever done. This is the sixth year that I'm presenting real estate trends for a year. And we read hundreds of articles and reports, and we find the mega trends that we believe are going to drive your success in 2021. So buckle in, this is going to be a wild ride, especially because I'm going to say some uncomplimentary things about California. Apologies in advance.
We're
So
ready for it, Neal. Go for
as
it.
as Kirk mentioned, 18 properties, about 400 million in our portfolio, about 400 investors. But what I really like to do is I love to teach. I love to explode myths. For those of you that are curious about the sort of projects that I do, the first row are townhome projects. These are large townhome projects. So 25 fourplex at a time, those sorts of things. The middle row are large apartment construction projects, also student housing. And then in the bottom row actually is one that I love, which is a new construction industrial or flex industrial project that I'm building. So that's half of my portfolio on the screen, all new construction. But half of my investors like cash flow, others like capital gains. So the other half of our portfolio are ugly buildings with beautiful cash flow. So those are examples of those. Um, and lots of happy investors that talk about our capabilities, primarily our data and analytics capabilities. I often like to tell people I'm running a data and analytics company that is masquerading as a real estate company. So far, we're successfully masquerading. No one's caught up to the fact that we're really just a data company that's applying our data to real estate. And lots of investors benefit as a result of that. In fact, I think we're distributing $4 million this year to our investors. Anyway, after all that chest thumping, let's get to the matter at hand. No review of 2021 trends is complete without a review of the year of misery. COVID caused more Americans to move than ever before, and those migration patterns are where our story is going to begin. We're going to connect those patterns with some economic tea leaf reading. From GDP to interest rates to stimulus, we're going to connect it all back to real estate. And then we're going to get to some forecasts. We're going to talk about single family. We're going to talk about apartments. You can ask me questions about other asset classes, senior housing, student housing. They're not in my presentation, but fire away at the end if you like, because I'm fascinated about asset classes other than single family and multifamily as well. And then I'm going to finish off my presentation with the most popular section. It's called the shootout. The best cities for real estate investment in 2020, 2021. And the good news is there's plenty of California. The final couple of slides are dedicated to my personal picks. One national city and one underperforming city that should do really well in 2021. Unfortunately, neither one of those in California, but there's plenty of good ones. All right, so here's the boring stuff. Educational webinar doesn't squeeze out the risk in real estate investing. My recommendation, not magic, they're opinions. Do your due diligence, consult professionals, and understand that even if you do all of those things, you could still lose money. Real estate and stocks are at-risk investments. Never forget that. Our story starts. It starts with a flashback of how the economy did in 2020. From stock markets to crazy GDP graphs, to unemployment, to rent growth. Let's set the groundwork for the mega trends of 2021 to come. I'm a real estate guy, so I start with what affects my investor profits the most, rent growth. Before the virus, rent growth in the US, rock solid, 3%, all types of assets at above trend growth. Occupancy was also at an all-time high. And then all hell broke loose. The virus plunged us into a recession, killed 550,000 people, caused catastrophic damage to our services industry. But for once, and I probably will never say this again, Congress actually responded spectacularly well with the initial CARES Act. So with the Fed's interest rate cut and the trillions of dollars in stimulus, that we saw the stock market and the real estate market go absolutely bonkers. We've seen that. And today the S&P 500 over 3,800, its highest ever. despite a second and then a third resurgence of the virus. I know lots of you are thinking, but Neal, the stock market doesn't make any sense. Tens of millions of Americans are out of work, so the stock market's too high. It's going to crash, Neal. Well, I have news for you. The stock market is actually right where it should be. And I'm going to prove that to you in 7 minutes or less. Those numbers all make sense. You just have to dig a little bit deeper. And the first place I'm going to dig is GDP growth. On the screen, you see this negative bar. The US domestic gross domestic product was negative 33 in Q2, highest decline on record. You know, I see that all the time in newspaper articles. You know what I don't see? That Q3 GDP growth was not negative. It was positive 33%. As you can imagine, that by far is the best growth ever in our history. All in all, Q2 and Q3 actually canceled each other out. Once again, something you never read in newspapers. They actually canceled each other out. Oops, back to starting video. There we go.
There
Okay.
you go.
So that may not make sense to you yet, but in a few slides, it's going to make sense to you as to why Q2 and Q3 canceled each other out. So GDP may have balanced out, but you know, a lot of people are like, Neal, but industries were hit so hard. The four biggest US airlines, they lost 25 billion. The NFL lost 38% of their revenue, and so many sporting and event venues have been closed since March, right? But none of those was hit as badly as the entertainment industry. Both the largest and the second largest theater chains in the US are going to be closing. And point though is that the government responded with the largest economic stimulus in US history. For some reason, we've forgotten how many zeros there are in 2 trillion. There's a lot. And the Federal Reserve didn't stand back either. The Fed's balance sheet increased by a staggering $4 trillion in the last 12 months. They bought government debt to help the politicians pay for that CARES Act. In all, the Fed provided 3 times the subsidies that they provided in 2008, which have yet to be paid back, in case you're wondering. They lowered interest rates all the way down to 0. And as you'll see in a few minutes, that lowering had some unexpected side benefits. Now let's take a look at unemployment for a second. This recession was wildly, crazily different from previous ones. In this chart, you can see the first 52 weeks of the last 5 recessions, all in a cluster, right? As you can see, 1 year after they started, roughly 20 to 30 million unemployment claims in those 5 recessions. The orange line is the 2020 recession. Only 31 weeks into this recession, we were already at 66 million unemployment claims. That's a stunning number. That's what people hear about, and it drives them nuts. Aha, but that's not the whole story. That's not the whole story. The whole story is that this was a bizarre recession. It was highly uneven. Hawaii is at 15% unemployment, Nevada at 13%. But there are 14 states in the union that already by November were under 6% unemployment. Now there's 26 of them, right? Bizarre, huge differences. We've never seen a recession like this. It was also bizarrely uneven depending on education level and income. On the left, you can see that people with less than a high school diploma, basically low wage earners, they were the most affected, followed by people with high school diplomas. By the time we look at the people with bachelor's degrees, that's the green line, there's practically no difference in employment between Feb and September. See how the green lines moved up the same level? I want you to remember that. Now, on the right, you see high income earners, medium wage earners were also not affected by. By August, these people were back up to their pre-COVID levels. It's the low wage earners, the under 16 bucks an hour, that have suffered and continue to suffer. So to summarize, bizarre recession, people with low income and low levels of education suffered the most. Tourism states suffered the most, while many parts of America have lost very few jobs, or in the case of one beautiful city called Idaho Falls, have gained jobs. With that background, I'm going to jump into my favorite 3 slides of this presentation. Here's the big aha moment that you need to take away from this presentation. The biggest thing that's holding many of you back today is that you cannot reconcile the suffering of tens of millions of Americans with these skyrocketing stock prices, the real estate prices. So millions of you are on the sidelines because you keep thinking that something is hugely wrong with the economy and there's a crash coming. And I was one of those people. I sat by the sideline for months. Then I decided to investigate, and here's what I found from the New York Times. The first bar on the left shows how much the economy gained or lost in terms of wages, right? Income. You'll be shocked to learn that the whole US economy only lost $43 billion in the first 9 months of the pandemic. Why? Because income inequality in the US economy is so high that people who have low paying service jobs are a teeny tiny fraction of the economy in terms of raw dollars. So $43 billion lost, still a loss of money, but there were gains. The second bar shows the unemployment benefits that came in from the CARES Act. These benefits were 25 times higher than they were in 2019, 25x, right? A total of $500 billion was added just through the unemployment clause of the CARES Act. And that doesn't even include the $1,200 stimulus checks. They added another $276 billion to the pocket of Americans. Income from businesses didn't go down. It would have gone down if it hadn't been for PPP programs and EIDL programs and rent relief. I get that. But the point is, it didn't go down. It didn't go down. How many of you would have thought that until you saw this graph? Most of you are like, yeah, businesses must have lost trillions. What trillions? There's no proof in the numbers that businesses lost trillions. In fact, business income went up a little bit because of all those programs. And then there were a bunch of other stimulus items added to the economy, state grants, hospital grants, local government grants, 265 billion. The bottom line is shocking. None of you would have thought this until I showed this to you. Compared to the same period in 2019, Americans actually had $1,000 billion more in disposable income. And I wish I could say that the trillion actually went to those that were in tremendous pain. We know that's not true. A lot of it went into the pockets of those that didn't need it, people like me. But hey, it's money. And those that had more spent more. I spent $200,000 rehabbing my house. Other people spent it on Teslas and Tesla stock and other stocks and real estate. So now you're beginning to understand why real estate and stocks are booming, but income is only one half of any story, right? We also need to look at spending. Let me be blunt. COVID scared the shit out of people. And when people are scared, they spend less. Here you can see that they spend $60 billion more on work chairs and gym equipment and monitors and webcams. They also spend $39 billion more on food and booze. But they saved an enormous amount of money on services. All that saved money from haircuts, restaurants, flights, concert tickets, added up to a staggering $575 billion in savings. $575 billion. Americans also saved $59 billion in interest payments, right? Bottom line, Americans spent $535 billion less than they did in the same time frame in 2019. And as a result, this massive combo of $1 trillion in higher income, 500 billion in lower income, it pushed America's savings rate through the roof. America's savings were a staggering $1.5 trillion higher than in 2019, a rise of 173%. So even as millions of the people faced incredible financial hardship, Americans as a group in the aggregate were building savings at a shocking rate that's never been seen before. And the savings, they all had to go somewhere, right? But where? Money under the mattress is one option, right? And sure enough, currency in circulation, it spiked. It's gone up by $260 billion. Deposits in commercial banks also way up by about 19%. But for those of us that are a little more comfortable with risk, there was investing in stocks and real estate and Bitcoin. Every market in the world went up because $1.5 trillion just for the United States is a lot of money. And as you know, once we did it, everyone else in the world followed. The world was suddenly flooded with a ridiculously large amount of cash. That's why every market in the world is up, even markets where COVID is raging. Now, does it make sense? All right, let's move on. Flashbacks over. It's time now to take a look at 2021. Let's look forward. We looked back, we understood what the consequences of COVID were. Let's look at all of the indicators. We know that GDP, or simply economic growth, is necessary for home prices to go up, rents to go up. So I'm delighted to see that the consensus forecasts for 2021 GDP growth are the highest in history. Typical consensus forecasts are usually 1.5% to 2% for the last 10 years. So it's fabulous to see a number as high as 3.56. And by the way, this was before the Biden $1.9 trillion bill passed. Now that that bill is passed, please Google On Sunday, 4 days ago, Goldman Sachs predicted 8% GDP. China doesn't get to 8%, right? At Goldman Sachs, these people are not fools. They know exactly what they're doing. Their forecasts have been very highly accurate in the last 10 years. They're predicting 8%. I kid you not. Goldman Sachs, 8% GDP, enter in Google, you're going to be stunned, right? Obviously, a lot of this makes up for negative growth. You see that number on the screen, right? Minus 2.98. But that was the past. We suffered. We all suffered. And now we're going to make it up. So I absolutely expect that we're going to crush this 3.56 number because this prediction was before that bill, that $2 trillion bill passed. I think we're going to crush it in 2021 and 2022. So let me know a year from now if I'm wrong. And then there's people complaining about inflation. It's like, yeah, too much growth, inflation. And the truth is no. In 2020, inflation was very muted, about 1%. In 2021, we expect it to double, almost double, right? But is that bad? In real estate, we actually like inflation to be a little bit higher than the Fed. The Fed likes inflation at 2%. People in real estate like it to be at 3%. Now, if it goes higher than that, then interest rates go up and that hurts us. But 2 to 3% is actually a Goldilocks zone for us. And we in real estate would actually prefer it to be closer to 3% than closer to 2%. We're going to get our wish. The unemployment rate in 2020, obviously, completely off the charts. There's no point in looking at it. But 2021 looks like a reasonable number, right? They're projecting 6%. After the COVID Act, projections are for 4%. 4% is considered perfect employment in the US. And we're now projecting that we're going to get there by the end of the year. That's incredible because when midway through this crisis, we were talking about not getting back to perfect employment until late 2023. Now we're talking about December 2021. That's how much things have changed. And our last indicator is interest rates. Big deal, right? As you know, the Fed cut the rate to 0. Then they did something bizarre, right? As far as I know, the Federal Reserve never in its history has offered long-term guidance on interest rates. But the pandemic was so potentially devastating that they made an exception. They let the markets know that they will keep rates low for years. And you might say, yeah, but that was last year. They said it again on Jan 27th of this year, right? So what they're saying is we will keep rates low for years. So as a result, we're seeing some of the lowest mortgage rates in history. Now people are like, yeah, but they're going up. Rates go up, rates go down. That is normal. It's just dependent upon the mood of the week. So from what we are seeing though, rates are a little bit above 3 right now. So this was in Jan, it was at 2.99%. We're looking at about 3.2% today. But if you look at all of the forecasters, they're coming up on your screen. All of the forecasters, look at their consensus at the top of the screen. The average is 3. Where are we right now? 3. Nobody believes rates are going up this year. And even if they go up to 3.25 or 3.5, remember that's still 1.5% lower than they were 15 months ago, right? So there's still an incredible amount of rate profit to be made in the marketplace. All right, moving on. And this is not a fun section for Californians. So, you know, if you don't like California bashing, time to leave. All right. America's migratory patterns were insanely disruptive. We had a super migration that happened. Let's find out what happened. So as you can see, it was not good news for the gateway metros. San Francisco, New York, Los Angeles, Chicago, they all lost populations to their suburbs. And where there are winners, there are losers. The Big Apple had negative rent growth because people were going to Newark. Denver lost people and rental profits to Colorado Springs. Seattle lost people to Spokane. California, unfortunately, was interesting in that it had a super cluster of losing cities. San Francisco, San Jose, Oakland, and Los Angeles were on the losing team for rents. Fresno, Sacramento, and Bakersfield were the winners. Bakersfield? Really? Bakersfield. I don't know. So people, by the way, are not just moving from cities to their suburbs. They're actually leaving the metros altogether. The states in green are seeing huge inbound moves. We invest in Idaho, incredible growth. Number one, no surprise. We also invest in South Carolina. That again, no surprise. Then we had Oregon and South Dakota, Arizona, Tennessee, North Carolina, Florida, all big winners in the pandemic super migration. Imagine 4 years of migration happening in 7 months, right? The states in light blue, they had some inbound migration. Some people moved in, slightly less people moved out. Texas, Utah, Washington, those are the big states in the blue group. The states in dark pink were the big losers. California, New York, Illinois, all hit very hard. But most of the Northeast states lost a bunch of people. Keep that in mind. And that was the states. What about cities? Well, predictably, the big loser was the Big Apple with 5 times the losses they had in 2019. And then after that was Chicago, San Francisco, Los Angeles. Surprisingly, San Diego bucked the trend. Yay, San Diego. And that hurt when it came to rents. The green chart on the left shows one-bedroom rents in big metros before COVID. The orange chart on the right shows the drop in rents after COVID. Take a look at San Francisco. Ouch. Remember that rent losses in the great financial crisis were 3%. Here we're at 24%. This is going to hurt, and it's going to hurt for a while because there's no way those multifamilies at this point have gone into foreclosure. And notice that rents really didn't drop nationwide. Take a look at one-bedroom rents nationwide, up 0.6%. It's just the gateway metros that all got their butt kicked. Okay, so those cities were hurt badly. What cities were the winners in this pandemic super migration? Well, I'm happy to say that 6 of the biggest gainers are the markets we're invested in. They're in the screen on the screen. And that's because we use analytics. None of the trends were started by COVID. We've actually been talking about these for a while. They were all accelerated, or should I say, massively accelerated by COVID. Other than these 6 that we invest in, the areas that gained population were Austin, Elon Musk's favorite, Dallas, and surprisingly, a number of slow-moving Midwest markets like Indianapolis. And it wasn't just, the cities. Rents actually fluctuated between suburbs and urban areas. So take a look at this. Suburbs, urban areas, right? I'm happy to say 100% of our properties are in the suburbs. So our markets saw robust rent increases, but urban rents were flat to negative on rent growth nationwide. Overall, looking at all kinds of properties in the whole country, we did see rents drop a bit, but nothing compared to the Great Recession. You saw that that recession hit real estate much harder. This one, not so much, 1%, not the end of the world. But just like the rent drop, rent growth, it varied a lot. It was all over the place, right? So here you see how different markets fared. You can pick out your favorite markets in this list. We invest in green markets. So one of our markets, Houston, we saw a tiny drop, but the other 4 markets, we saw massive rent increases, especially Phoenix, where our biggest project is, just a gigantic increase in prices, in rent prices. What about sales prices? And I'm giving you multifamily. I'm going to come to single family in just a minute. We saw a teeny tiny bit in dip in multifamily prices at the beginning, but it only lasted 1 quarter, and that was Q3. Q4, they flattened out. Q1, they're up again very significantly to the highest price that they're up here somewhere in close to the 180 per unit mark. So multifamily is now again at all-time highs. So really only dipped for 1 quarter. And as a result, apartment cap rates are the lowest there in history and heading lower. Every broker I've spoken to, every economist I've spoken to says, we're about to see a massive cap compression multifamily. Some of you are not multifamily people, ignore what I just said. The ones who are, it's a big freaking deal. We might see several years, 2 to 3 years of cap compression in 3 quarters. None of that matters if you don't collect rent. So obviously the government prevented evictions. Landlords are fixated on rent collections. Nationwide rent collection was very good. 94.7% of renters are paying rents. You look at, on the left, you see 2019 collection, 2020, they sort of look similar. So it's not gloom and doom. California, unfortunately, didn't fare that well because it's very tenant friendly. So we did see rents go down, but again, didn't feel like gloom and doom in California. I do have 10 single families here. Not as happy as I was in 2019, but it wasn't gloom and doom at all. So I was actually impressed with how well California did through this process, given how tenant friendly we are. All right, that was my commentary on multifamily. I also own 10 single family homes. And so I like to talk about the single family rental market, right? I gave you some bad news. It's time for some good news. So our single family story starts with foreclosures. A lot of people are obsessed with foreclosures, right? In 2010, on the left, nearly 3 million homes in the US went into foreclosure. So lots of supply for new homeowners, landlords like me. I bought 10 of them in Madera, California. But by 2019, look at that bar. That 3 million was at to 500,000. So effectively, foreclosures are not adding much to the supply. I mean, 500,000 foreclosures is not a big number to move anything, right? Of course, 2020 has no foreclosures. The government banned them. 2021, they'll tick up a little bit. But all those of you that are expecting this, I hear this tsunami of foreclosures, well, you're going to be very sorely disappointed, I promise you, because unlike 2010, slightly more than 98% of the homes that are delinquent have equity in them. They have money in them, right? So only about less than 2% are upside down. This means that when push comes to shove, owners are going to sell them instead of letting a bank foreclose on them and destroy their credit. So if you're waiting for foreclosures, good luck to you. You're going to be waiting for a long time. Another reason why there's not going to be foreclosures is there's massive single family demand in the rental market, right? And because one surprising megatrend that we're seeing is that richer renters, more affluent renters, are actually turning to single family and townhome rentals. In fact, this graph shows that since 2012, the percentage of renters making more than 100,000 has grown from 8% of the market to 13%. And most of these renters, either they want townhomes or they want single family renters instead of apartments. And the renter demographic in the US, it's changing so much. I mean, 20 years ago, most renters were young singles. Today, things have changed so much. Take a look. Young families are renting more, middle-aged families are renting more, mature families are renting more, multi-generational families are living together in large single-family homes. And then take a look at a spike in single parent rentals. All of these groups prefer to rent townhomes or single-family rentals over apartments. So there's lots of demand right now for both townhome and single-family rentals, and it's driving up home prices. And look at this upward pressure in median home sales price, right? People are, their income is rising at 2 or 3%. Home prices have been rising at 6 to 10%. And so as that ratio goes up, more and more renters, permanent renters, are being created because they simply cannot afford to buy a home unless home prices crash, which is very unlikely at this point. In fact, today, 50% of renters say they cannot afford the down payment to buy the home, and nearly 30% cannot qualify for a mortgage. And as a result, right, more and more renters are being created. And you might think, some of you might think, oh, builders are going to fix this. They're going to build more homes. I know it. They always come in. Yeah, but take a look at what happened during the pandemic. Except for March and April here, right, when the pandemic started, builders sold more homes in 2019 in every month. If you look at August, September, October, they're November, right? They're selling 300,000 more homes each month than 2019. So this whole thing about builders building more is a myth. They're building as many as they can. Lumber prices are more than 3 times what they were 12 months ago. I don't think they can win anymore. Notice that at the top, it's completely plateaued out because there are things that prevent builders from building more. So while individual cities might have oversupply, we're seeing no evidence that builders are going to be able to build enough homes. And as a result, we're seeing projections. Realtor.com says 6% increase in single family price, seller-friendly market. The chief economist at Redfin says that sales volume is going to be so high that it'll be the highest for any year since 2006. We remember how crazy that year was, right? You guys are not that young. So I know. I had to take that shot. So even Zillow, these guys tend to be the most bearish. They tend to be most conservative. They're shockingly bullish. They're forecasting that 2021 will be the biggest one-year gain in sales since the 1980s, when home prices were $200,000 lower than they are today. And look at all these different projections from all the different guys. I think the one, and all of these were made before the Biden bill passed. All of these people have come in and said, now it's got to be higher. And they're all leaning towards that 10% number that we see with Zillow. 10% is something that Californians are used to, but 10% in the US is not a common number. It's definitely not a common number. And obviously California has slowed recently. We've all seen that. And then it started to spike again in the last, 5 or 6 months. But 10% in the US means that parts of the US could be at 20%, right? There's slow going parts of the US, especially the Midwest, the Northeast, that tends to grow at about half the rate. But then there's part of the US like California and Nevada and Arizona, Utah, Idaho especially, that actually tend to grow at almost double the rate. There are going to be states at the end of this year, and I'm not brave enough to say which ones, that will have grown their home prices, the entire state, by 20% in the next 12 months. That hasn't happened in the history of the United States. It didn't happen in 2006. Crazy, right? Absolutely crazy. Doesn't mean you don't want to, exponentially grow your earnings by picking the best cities in the US for 2021. So I'll show you some of the best cities for 2021 for investment. Some are in California, some are outside. Before I do that, I'll tell you what I'm doing. I love multifamily. I'm a multifamily guy. I build lots of properties. I hold lots of properties, but I cannot ignore the fact that right now the single family market looks like it's going to be hotter than multifamily for the next 5 years. So it's too late for me to come in and start buying or building a few homes. So guess what I'm doing? I'm building large collections of fourplexes, 50 at a time, 132 at a time. And those fourplexes are rental fourplexes. We find that rental fourplexes are especially if they're built in a community that has centralized management, are the most profitable product in the world. And I'm actually taking my payment from my investors in fourplexes because I can't build them for myself. I might as well build them for my projects and keep, the profits in fourplexes as well. I'm building them in the two strongest markets in the US, Texas and Idaho. Idaho is the fastest growing state in the US because it's compressed between fast growing Utah, fast growing Arizona, and super fast growing Seattle or Washington state. So it's a compression state, right? States that are in between all the good stuff tend to grow fastest. So Boise is the fastest growing city in America, and Idaho is the fastest growing state. So I'm building them there. I'm also building them in Texas. We build them at different price levels. Boy, it's incredible. I mean, people buy them 2 years before they're built. 2 years before. So if any of you are interested in learning more about these, let me know, or check out our website. This is a very long sales pitch. I'm just going to skip past it.
Thank you. That's appreciated.
Skip, skip, skip. Skip, skip, skip. Skip, 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 more skip, skip.
It's getting there. It's getting
Yes, there we go.
There you go.
End of sales pitch. So when I do look at best cities, I like to give you feedback, but I like to pick what the forecasters are saying. So what I do is I pick 2 forecasters that I like the best, that have been the most accurate for single family. And then I like to pick 2 for multifamily. And then I give you my candid comments, which could be right or wrong. So take them at, whatever face value. All right, Zillow. Here's the markets that Zillow likes, right? Incredible list, right? So I've been screaming about Boise and Idaho for 3 years to anyone who cares to listen, right? Idaho's economy is an absolute supernova. Boise's at the center of it. That's why my company invests. I don't invest, by the way, in Boise. It's too hot. I invest in Idaho Falls, which is the second largest city. Now, if you look at the second one on the list, Tacoma. Why Tacoma? Seattle, right? We've seen this here when Los Angeles does well. You see, the Inland Empire do really, really well. Oxnard starts to do well. Riverside does well. Same thing's happening here. Tacoma at number 2 is basically just benefiting from Seattle. At number 4, Spokane, benefiting from Seattle. At number 7, Seattle itself, right? So as you can see, that's a very strong Washington state effect that's going on right now. Nothing surprising in this list, but there's a nugget here for those of you that would consider investing outside of California. It's not Boise. It's too late there. It's not Tacoma. It's not Spokane. Definitely not Cleveland or Buffalo or Seattle. It's a tiny little city called Killeen in Texas. The most powerful real estate effect in America is the Austin effect. As many of you have heard, Silicon Valley is slowly moving to Austin, right? So we've seen Oracle move. We've seen, Elon Musk himself has moved, and Tesla's building a massive factory in Austin. There's so many other companies. I mean, the list of companies moving to Austin is just endless. Austin's expensive. I mean, I like to say Austin is the cheapest city in California. And people are like, what? So I say, well, what I really mean is Austin is the cheapest Texan city in California. Because if you look at it, its real estate it's like California, right? It's not like anything like Texas. Texas is not supposed to be that expensive. So home prices in Austin have already crossed $450,000, which is ridiculous for a Texan market where there's land everywhere. But 67 miles from Austin is a tiny little city called Killeen, right? And Killeen's just, sitting there doing nothing. And then all of a sudden, this Austin economy explodes. Now, for those of you that are like, nah, it's 67 miles is too far. Well, okay. Los Angeles, Riverside, San Francisco, Sacramento, 114 miles. You saw how Sacramento has exploded, right? Sacramento has been the big success story in the next 5 years. In terms of percentages, it crushes everything in California. Nothing comes close in terms of percentage growth than Sacramento. And Sac is 114 miles away from San Francisco. Killeen is 67 miles from Austin. Home prices in Austin, 450,000. Home price in Killeen, 146,000. With the pandemic, I think it's entirely possible for an engineer to buy a beautiful, massive $300,000 home in Killeen. That would be a $2 million home in California, drive into office twice a week, and have an incredible lifestyle. That's my tip for you on the top 10 cities. There's a second tip, Indy. Cleveland, I don't like, no population growth. Indy, I like, lots of population growth. Even though Indy is heavy crime, but still it's a city that I like. Note that in California, there is a city in here, yay, Stockton. There's a city in there. Now, the good news is that for those that like expensive markets, the other provider that I look at liked California a lot. So San Jose, #1 in the list. Sacramento, #4. Riverside and Oxnard, the cheaper markets in Southern California, are at 6 and 7. That's pretty impressive for California this late in the game to have 4 fast-growing markets out of 10, right? So Realtor.com definitely likes California a bit more. So I think if I had to bet, I'd bet on Riverside, Oxnard, and Sacramento. I'm not so hard on San Jose at this point. I think that the impact of the office impact has not been felt yet by San Jose because the leases are pretty long. But when these leases stop renewing, right, but they get to that point, a lot of people will not renew them. And I think San Jose is really going to feel it towards the end of next year, though it might do really well in the first half of the year. My other favorite picks from this list, Charlotte, North Carolina. North Carolina has an incredible economy. All right, that was single family. Most of you are not multifamily people, so I'll just give you a few nuggets here of places that I like from this list. Inland Empire at #1. Once again, California makes all the sense in the world. People moving to less dense areas, people okay with moving away from the traffic of California. And #2, Sacramento. Both of those make perfect sense to me. And I think they'll continue to do well on the multifamily side. So if you're looking to do apartments, look there. Vegas, I think, is risky. Phoenix makes all the sense in the world. Incredible market. And then once again, you see a Rust Belt city. Very rare to see Rust Belt cities in top 10 lists. Indianapolis. Pay attention to Indy. Atlanta is always in these lists. The 2 superstar cities in North Carolina are always in this list. So you've got Charlotte, you've got Raleigh. Interestingly enough, nothing in Texas and only 1 city in Florida. So super hot markets, cool. They're not always super hot. And so that was the first provider. I always match it with the second provider. All I have to say is they matched. So Phoenix, Atlanta, Tampa, Kansas City, Indianapolis, Raleigh, all repeated in that list. So the multifamily guys, they said the same things. Whereas in the single family, you notice that realtor.com was very hot in California and the other provider was not. So those are my best markets in the US. I kind of gave you my feel for which ones are the best. I finished the presentation by sticking out my neck. So my past picks for best city in 2016, 17, and 18 were Provo, Utah, and Boise, Idaho, right? Those are my 16, 17, 18 picks. And then in last year, I had a tie with Raleigh and Charlotte as my top pick and San Antonio as my dark pick. This year, for the first time in my history of doing this presentation, I've picked a city in the Midwest. While crime remains a concern, Indianapolis has a fast-growing population, substantial income growth, home prices are going completely insane. I'm unlikely to invest in Indy, but I do think that this market is underpriced, offers some very serious bargains for investors. Just stay away from the high crime areas. And now my pick for best city in the US for real estate is Phoenix, Arizona. After missing out narrowly, it came in second 3 consecutive years. I am delighted to declare this is unquestionably the best market for 2021. It is the fastest growing large city in America. It's got so much going for it that COVID has had almost no impact on its employment, on its rent growth, on its home price growth, on its apartment growth. Almost no impact. I think maybe one other city in America can say that, Idaho Falls. And I do expect that Phoenix is going to continue to fly in the coming year. That's my presentation. We do 26 different presentations at multifamilyu.com. You're welcome to join us. We have about 40,000 people that watch these webinars each year. We'd be happy to add you to our community. If you're interested in fourplexes, my email address is up there. I'm happy to take your questions.
Okay, Neal, I have to adjust my thinking. I'm just letting you know. I said you almost walk on water. Okay, you do walk on water. I just wanted
very
to say.
kind. You're very
So this
kind.
is amazing, Neal. If we were
Call me
in a
Jesus.
live room, we'd all be able to stand up and applaud and stomp our feet and say thank you for this amazing information. So guys, we get Neal for I think about 10 more minutes at the most. So if you want to start putting your questions in the chat, please do. I will start with a question, Neal, if I may.
Yep.
So the question that I have and the thing that I have been watching is unemployment due to COVID shutdowns on small businesses. My concern originally, which is no longer my concern originally was that it would increase unemployment so greatly due to the lack of jobs being available for that low wage earner. But now seeing the amount of oversupply of money through the system that you've now described to me, and also the concept of pent-up demand, I have a different thought and forecast on it. What's your thought and forecast on what's going to happen to the low wage earner after COVID shutdown is done and we have the unemployment because of the closing of small businesses?
I expect it to bounce back much stronger than most people are expecting and much quicker than most people are expecting. I track a number of forward-looking trends. I've learned a few things with the pandemic to track these new trends that I wasn't tracking before. So I'm tracking how many people the TSA is sending through airport turnstiles.
Okay.
That number is projecting twice as fast as it was going to. So in the mind of Americans, the pandemic is ending. It really doesn't matter that it's going to continue killing people. From a mental shift perspective, it's ending. So from an economic perspective, the tourism industry is now projecting the biggest boom in their history, except for cruise ships, which are still saying we're not sure. But everybody else is saying that when they see people checking out websites, Kayak is saying we've had traffic of the kind we've never seen before on our website. Airbnb is saying, wow, things are looking great. I'm reading all of this stuff. An incredible percentage of low-end jobs are tied to travel, tourism, and hospitality.
Right.
I expect all of those will open. I expect that obviously lower-end jobs trail the higher-end jobs. The higher-end jobs really didn't go away because companies kept their employees. But lower-end jobs, we saw a massive just decline. We think that the U.S. will open in the next 30 days. We think that even the most bullish projections are wrong. We think that most states will open vaccinations to everyone by the 10th of April. That's what, 22 days from now? By the 10th of April,
For everybody.
every state in the US will open vaccinations to anyone older than 16 years old. Because when I'm looking at the vaccination math, we're going to have way too many of these things. I bet you we at least donate 300 or 400 million vaccines.
Okay. And the
So
vaccines
I
make
think it'll
all
be
the
very
difference.
strong. Yeah,
Sorry.
yeah.
No, I happen to agree with your thought, but not because I'm so bright, but simply because I listen to people like you. I happen to agree with your thought, which is that the pent-up demand is going to be such a strong driver that the concept of the loss of jobs due to small businesses being closed, those businesses are going to be up and running again, or somebody's going to try to fill in that spot in 6 months, 8 months, 12 months. And so I think that loss of job is going to be temporary, and the pent-up demand is going to push us right across what may have been a gap in that unemployment.
Yeah, I think it's going to get filled up. So I am usually known for being a bear. I am not bullish by nature. I'm very conservative, but the economic indicators are all aligned in one direction and very strongly aligned, which just never happens.
Right.
You're not going to get something like this. COVID was a 100% reset of the world economy. You never get every economy in the world coming out of a recession at the same time. It will never happen again in history, right?
All right.
So that it's huge. It's huge. I do see a couple of really great questions. I'm going to
Yes,
jump
go
to
for it.
those,
That's exactly
right?
where I was going to go. Let's
Yeah.
pull some questions from the chat. You want to pull them? You go for it, Neal.
Yeah. So Phoenix for both multifamily and single family. The answer is not for multifamily, not for single family. It's Phoenix is too hot. What I suggest is Phoenix suburbs. Look at Mesa. And if you still find Mesa to be too expensive, here's my pick for Phoenix. 44 miles east of Phoenix is a tiny little city called Buckeye. I think Buckeye is an incredible buy. Now, one of the reasons is that Bill Gates, you know Bill Gates, right? Bill
I heard
Gates
of him.
just bought a city's worth of land outside of Buckeye, and then he bought a few thousand acres inside Buckeye. So Bill Gates is building a new city. So Google Bill Gates City, Arizona, Buckeye. And you'll see how shocking his plan is. If he builds 1% of what he's planning to build, Buckeye real estate could triple in the next, I don't know, 4 years. So that's my pick. It is Phoenix. It's not hard to drive. It took me about 35 minutes, 40 minutes to get from Sky Harbor International to the middle of Buckeye. All right, let's see. Does your avoidance of Cleveland include hot area multi? No. I think you'll do fine in Cleveland with multi. I'm not saying to avoid Cleveland. Look, it's in the top 10 lists. You misunderstand me. All I'm saying is I typically don't recommend cities that haven't seen population growth. Clearly, there's lots of good things happening in Cleveland. Why would a city show up in a top 10 list if good things were not happening? So I do not want to turn you away from Cleveland. It's just not one of my top picks. Other people consider it one of their top picks. All right,
Okay.
let's see. Here's one that is very important, right? So today I've given you mostly good news. A lot of my presentations are mixed, but today is mostly good news. Can you comment on the recent Fannie and Freddie announcement on their limit on buying investment property mortgages? Yes. It scares the shit out of me. Investment properties are running somewhere around 13 or 14% of Fannie and Freddie's portfolio. They want to limit it to 7. If they do that, they will raise interest rates on investment properties by 2% to clamp demand down. That is catastrophic news. But in the end, from what we hear, this is a plan. I think that would cause an immediate real estate crash. And I think the Fed will come and talk to Fannie and Freddie about this and say, are you crazy? You want to do this in the middle of a pandemic, right? We're still in the middle, technically. So I think that it gets pushed back. I believe that this is the Democrat, influence, where Democrats are saying home prices are going up too much. The best way to slow them down is to prevent investors from investing. I think what will happen is if they do it, you'll see a massive spike in interest rates for investment properties. It'll be very painful, but then you'll see the private market flood in because Fannie and Freddie are not stopping other people from taking $1 billion from them and chunking it up themselves as for investment properties, right? And when you get money like that from Fannie Freddie, or you get it from the bond market, that money is still available extremely cheap. So I do think that what will happen is that the market will fill out with non-Freddie Fannie people coming in, but there's going to be a 12-month period of extreme pain, and you might see cap rates go up, you might see prices go down on investment properties, especially larger properties, when that happens. Yes, yeah, I'm afraid, and I'm watching very carefully. Let's see. Boom, 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 boom. All right. I don't think the meat tenderizer is for me, so I'm going to skip that one.
No, it's for you.
Okay.
They're
All right.
more further down.
Forecasts on meat tenderizer and hydrogen peroxide. All right. How do you do your data analysis? Do you analyze the numbers yourself? Where do you get the data? So we get data from the BLS, the Bureau of Labor Statistics website has free data. City-data.com has terrific data, and so does neighborhoodscout.com. Those are three of our favorite places to pick data from. We do our own mashups. Everybody does their own. We also pay for two sites that have very interesting data. One is called localmarketmonitor.com, and the other one is called housingalerts.com. I'll give you a quick preview. The number one, number two, and number three markets, according to Local Market Monitor, out of 600 markets, are Idaho Falls, Pocatello, Idaho, and Boise, Idaho. The number 1, 2, and 3 markets, according to the other website that I've just mentioned, are Idaho Falls, Pocatello, Idaho, and Boise, Idaho. So I think they either they've figured out the same exact data, or they're colluding with each other. I can't tell which.
All right, there is a question in here I don't think you can see after the Philly question. So if you want to take the Philly question, I've got one nestled in here that's blind to you because it came straight to me.
Yeah, so I saw Philly at number 11 for multifamily. What are your thoughts on Philly for the next few years? I think it'll do well. Philly is one of those cities that I root for. It used to be one of the great cities in America. I think it was number 2 or number 3 at some point in the past. It just never lives up to its potential. So it's disappointing. I still would like to see more population growth. I think it will do fairly well over the next few years. I think that if you live in Philly, it makes sense to invest there. You shouldn't be afraid. If you don't live there, there are better options than Philly.
Okay. This one talks about development in Los Angeles building units. Do you think it's possible that post-COVID, people are going to need housing and there are no foreclosures? Are they going to be increasing development in LA?
No, I think that what we are going to see is a wave, an absolutely massive government-supported wave of dezoning.
Okay.
So it's already started. Sacramento has almost passed a law to completely ban single-family zoning. Oakland's considering it. A whole bunch of other places are considering it. Minneapolis has successfully passed. Basically they said everything within city limits is now 1 to 4 units. So if you have enough land, go ahead and build 4 units. I think that California is going to be ground zero for rezoning. Now, rezoning obviously is development, but rezoning is much more sustainable development because you're using the same land that you already have. It's also more sustainable in that it's much more profitable, because if somebody owns a single family and they can build more on it, that's great. And I know everybody's like, yeah, Neal's talking about ADUs. No, I'm not. You can take a single family and add an ADU to it. I'm talking about them zoning it so that it becomes a fourplex, right? You can still stick that ADU in there if you have enough land, but you can demolish your single family and build a fourplex, take 1 unit in it as your profit. Now you got a brand new unit, and you basically are renting out the other 3 units. That wave is unquestionably here. The Democrats always wanted it. The Republicans were against it. But what I'm seeing these discussions in Republican states throughout the United States. It's happening everywhere. And the blue states are all looking at it. Oregon, Washington, especially California. You're going to see massive dezoning. And honestly, I have to say this. It's got its own problems, right? Because you're going to have too many people living in an area. It kind of creates density. But what choice do we have? Has any other country in the world figured this out? If you go to Singapore, one of the happiest countries in the world, you see all these towers, right? Singaporeans live in beautiful apartments, but they're still apartments. And they're, 50 floors high.
Yeah.
You go to Europe, you see, have you seen a European city from the air? It's basically townhomes everywhere, right? I'm taking the family to London in June, and we couldn't find a single family home on Airbnb, but we found 600 townhomes. So in the end, the United States is not a magic place. We ran out of land like every other place. It just took us longer because we had more land. Now at this point, the next 10 or 15 years, the trend is all about dezoning.
Okay. Last question in this little piece was, what about pivoting your developments in Texas? Do you need to be prepared just in case the market goes sour, or you think you're ready to just move forward with developing in Texas?
I continue developing in Texas. I'm more cautious. I don't over leverage. There's no evidence that the Texan market is, quote, crashing. The Texan market is slowing. Notice that 5 years ago, the top 10 would have been half the cities would have been Texan,
Yeah.
right? Or Floridian.
Yeah.
But you notice there was very little Florida, very little Texas. They're slowing, no doubt. But fundamentally, Texas and Florida are two of the strongest states. Their fundamental growth is extremely strong. Obviously, they've run like crazy for a while, and everybody takes a breather. But when the underlying economy is so strong, another set of another growth cycle will start. I don't think that you should bet against Texas. Very difficult.
Cool. All right, pick a few more questions because I want to honor our agreement of 10,
Awesome.
of 8:10, 8:15.
Yes. So Ray's comments, my feedback is this: shadowstats.com is not the #1 source for better numbers. Ray, you like conspiracy theories, so you believe that shadow stats is true. The real answer is that inflation in the US is not 6 or 7% as shadow stats says. That's nonsense. That's one debunked person. Inflation in the US is somewhere in between the Fed's number and shadow stats, because some of the things that shadow stats says, I look at it and say, this can't be absolutely right. It just makes no sense because it doesn't actually match up with real numbers in the economy. When I look at the price of an orange, shadow stats doesn't work. So bottom line is, when you say this, my feedback is you like conspiracy theories. As far as crime hitting blue cities, it's a trend. I think that these cities need to adjust, but keep in mind that we've had crime sprees in red states as well. So there needs to be some perspective here, Ray. Like, you have this diatribe of things that I don't like, because what you're saying is everything's one way, and it's not. Why don't you study crime in red states? Why don't you study crime in Texas, in Florida? Study crime in Memphis. Crime's everywhere. Cycles happen. Some of the blue cities are going through those cycles. But I do think that there's a balance to be made there. I do think that you're right, that red states are likely to grow faster than blue states, but for a variety of reasons, right? It's not just because blue states have more legislation. Red states have more space.
Okay, one more, and then we'll let you
Last
go.
one. All right. Let's see. Lots of potential black swans that may impact the economy. I do want to talk about this.
Okay.
I think the world economy is now set for a black swan event like the coronavirus every 5 years. I know that's terrifying to hear, but I think every 5th year is going to be like this. We just need to all talk about and understand resilience. Unfortunately, I'm in complete agreement with Ray Ritchie that black swans are accelerating. They're accelerating due to the nature of technology. The underlying nature of technology is what creates black swans. And if you don't understand that, you really need to understand why technology creates more and more disruption in the world economy. So good disruption and bad disruption. We'll take that as the last one.
Neal, you're amazing. Thank you so much for making the time to show up tonight. Really, really appreciate it. This is highly valuable. We post, you may not know, but we do post the presentations on Phoebe Pasadena YouTube. So this will be available to people. We're hoping to get up in about 2 weeks so that this information, because it's so timely, will move forward. Neal, if there's anything you need at any point in time, you're always free to contact me. People, make sure that you see Neal's information. If you want to invest with Neal, you want to pick his brain, you want to take advantage of his power-packed webinars on his website, please do. There's lots of very good free information there. And you can see that Neal is very easy to reach out to, and he will respond to you, or his assistant will respond to you if you have any questions about where he's investing his money and if you guys want to invest with him and his company. So Neal, do you have any workshops coming up or anything?
We do them every week. If you go to Multifamily U, they're constantly coming up. So I suggest you check them out at Multifamily U. This year we're doing a lot of them because I'm not doing any live conferences.
Okay.
So there's a lot more.
Thanks you
Awesome.
very much.
Thanks,
Thank you, Neal.
everyone. Thanks,
Appreciate it.
Kirk.
Goodbye.
Bye-bye.
Thank you.